Alright, this is problem 2.2. It's meant to illustrate the first 4 steps of the accounting cycle. Analyze the transaction. If there's something to record, make a journal entry. Once we make the journal entries for the month, post them to their accounts, and then prepare a trial balance. And our rules for journal entries are that they always balance, that assets increase with debits, liabilities and owner's equity accounts increase with credits, expenses are debits, expenses are debits, expenses are debits. Sales or revenue, which is the opposite of expenses, must increase with credits, and drawings starts with D. That reminds us that they're recorded with debits. First transaction on April 1st, Vera Ernst invested $20,000 into her business. Is there something for us to record? Yes. Cash is changing hands. What's happening to cash? It's going up. Cash is an asset. Assets increase with debits. What's happening to owner's capital? It's going up. She's investing more capital in the business. So we debit cash for $20,000. We skip down a line, we indent a little bit, and we credit owner's capital for $20,000. We don't debit and credit sentences. We don't say owner invested capital. We say owner's capital. That's the name of that account. Next, we hire a secretary receptionist. He hasn't started working for us yet. We don't write him a check, so there's nothing for us to record. He hasn't earned anything. We don't owe him anything yet. So this one's a bit of a trick question. There's nothing for us to record regarding that hire. Next, on April 2nd, she paid office rent for $1,500. Rent is an expense. Expenses are debits. Expenses are debits. Expenses are debits. So we're going to record rent expense for $1,500, and what's happening to cash? It's going down. Cash is an asset. It increases with debits and decreases with credits. So we debit rent expense for $1,500 and credit cash for $1,500. Remember, we're just journalizing the transactions now. We're answering part A, which is actually step 2 of the accounting cycle. The next transaction is on April 3rd. She purchased dental supplies on account. So supplies is an asset. Assets increase with debits. On account means we're going to pay them later. That's called an account payable. Any account that has the word payable in it is a liability account, and liability accounts increase with credits. So we're going to debit supplies and credit accounts payable. And if we're doing things exactly right, we'd write a little memo down here to tell the next person exactly what just happened. The next thing that happens is we perform dental services and send out a bill. Well, when we send out a bill, that means we're going to receive money in the future. That's called an account receivable. Accounts receivable are assets. Assets increase with debits. And we've earned some money here. We've performed some services, so we have some service revenue. If expenses are debits, the opposite of expenses is revenue, so those must increase with credits. So we debit the asset accounts receivable for $5,100 and we credit service revenue for $5,100. That keeps track of the money that we've earned, whether we get paid today, tomorrow, or never. Next, somebody pays us in advance for work that we're going to do later. What's happening to cash? Cash is increasing. Cash is an asset. Assets increase with debit, so we're going to be debiting cash. But we can't credit a revenue account because we haven't earned it yet. So this is unearned revenue. When we get paid in advance, that's called unearned revenue. That's a liability account, and liability accounts increase with credit. So we debit cash. Cash is an asset. Assets increase with debits, and we credit unearned service revenue. That's a liability account. Then on April 20th, we received some cash for services performed. Well, that means we earned it. So we're going to debit cash and credit service revenue. If expenses are debits, the opposite of expenses is revenue accounts. It must increase with credits. So we debit cash and we credit service revenue for $2,100. Then on the 30th, we finally pay that secretary receptionist that we hired on the 1st. Now there's something to record. He has done some work for us. We owe him money and cash changes hands. So we have to make a journal entry. What's happening to cash? Is it going up or is it going down? It's going down. So we have to write the debit first, but nobody said we had to figure out the debit first. So we're going to credit cash for $2,800. And what are we paying? We're paying salaries and wages expense. Expenses are debits, expenses are debits, expenses are debits. So we're going to debit salaries and wages expense for $2,800 and credit cash for $2,800. And if we had more time, we'd probably write a little memo down here to tell the next person exactly what that was all about. In the last transaction, we pay off $2,600 of that $4,000 that we owe to Dazzle Company. So accounts payable is a liability account. It increases with credit, which means it decreases with debits. So we're going to debit accounts payable for 2,600 and credit cash for 2,600. So that is part A to this problem, which is steps 1 and 2 of the accounting cycle. We analyzed each transaction, and if there was something recorded, we created a journal entry. A journal entry has the same amount of dollars for debits as it does for credits. We debit and credit specific accounts. We don't tell stories. And that's step 2 of the accounting cycle. Step 3 of the accounting cycle, which is part B of this problem, is to post to the general ledger. So what happens is my boss walks in and says, how much cash do we have? I don't know, boss. I haven't posted yet. This stuff is organized in chronological order. Now let's reorganize it by account. So part B and part C are very mechanical things that we have to do. Let's post that $20,000 debit to the cash account. In T account world, the left-hand side is debits and the right-hand side is credits. Now let's post that $20,000 credit to owner's capital. And we would do the same thing for all these transactions here. And let me give you a hint of where the cash balance should end up. When you post all the transactions that involve cash, your cash balance should end up with 3 debits and 3 credits. Add up all the debits, subtract all the credits, and you should end up with a balance of 16,200. So we post all our debits and all our credits to the T accounts. We can't see them, but I have T accounts down here at the bottom, so we cover every single account. We strike our totals. So cash has a balance of 16,200, accounts receivable 5,100, supplies 4,000, accounts payable has a balance of 2,400, $4,000 worth of credits, $2,600 worth of debits, unearned revenue, etc., etc., etc. Now it's time to create the trial balance. We simply list all the accounts in a special order: assets, liabilities, owner's equity, revenue and expenses, and list the balances next to each account. And the book, I told you that the balance for cash is 16,200. The book tells you the balance for the debits and the credits for all the accounts is 29,600. And that's all there is to problem 2.2.